when you see a luxury electric vehicle, just kind of glide past you on the street.
Right, they're completely silent.
Exactly. Silent, sleek, the paint looks like liquid glass, and you instinctively assume the company that built it is running with that exact same frictionless perfection, right?
I hope so, yeah.
But then you pop the hood, not on the car, obviously, but on the financials. And suddenly that silent machine sounds like a jet engine that is it's actively tearing itself apart.
That is a very accurate way to describe what we're looking at today.
Yeah, so today we are unpacking the brutal reality of Lucid's business. And we're pairing that with this fascinating leaked media playbook we got our hands on. It shows exactly how financial YouTube channels kind of weaponize this specific type of corporate panic to sell you AI subscriptions.
It really is this remarkable collision of two completely different worlds. On one hand, you have the physical reality of manufacturing electric vehicles, which, is arguably one of the most capital-intensive businesses on Earth.
Oh, absolutely.
And on the other hand, you have the digital financial media ecosystem. And that requires almost zero capital, but it thrives entirely on the volatility and really the anxiety generated by those physical companies.
Yeah, and I want to look at the raw facts first, because I was staring at this August 2026 equity research report on Lucid, and my jaw actually dropped.
The numbers are intense.
Intense is an understatement. I know the EV market is tough right now, but these numbers look completely unsustainable. Walk us through what actually happened in their Q2 earnings.
Well, the word grim comes to mind.
Yeah.
Wall Street had a consensus expectation for Q2 2026 revenue of about $416 million. And they came in at $405 million.
So a miss.
Right, a miss. But, the revenue miss isn't even the terrifying part here. The loss per share came in at $3 compared to an expected $2.46.
Wow.
Yeah. And if you zoom out to look at the year-over-year context, their net loss nearly doubled. They basically burned through approximately $1 billion in a single quarter.
$1 billion?
Right.
In 3 months. They're just setting fire to capital at this point.
Exactly.
But, the metric that really stopped me in my tracks was the gross margin. The report notes a trailing 12-month gross margin of negative 92.46%.
Yeah.
And a net margin of negative 239%.
Which is really the core of this entire crisis.
Right.
That negative 92.46% gross margin means that before you even factor in research, development, marketing, administrative costs.
Just the basics.
Yeah, the actual physical cost to build the vehicle is nearly double what they are selling it for.
Right. Okay, so to really visualize that for you listening, let's think about a lemonade stand. But not like a little cardboard stand on a sidewalk.
Right.
It's like deciding you want to sell a premium cup of lemonade for $100, so you go out and you sign a lease on a massive state-of-the-art commercial kitchen that costs you like 10 grand a month to rent.
That's a great analogy.
And you buy these industrial-grade citrus press robotics, but then if you only end up selling 5 cups of lemonade all month, each of those cups effectively cost you thousands of dollars to produce.
This is the overhead.
Yeah, exactly. The core business model is just structurally upside down.
It is. And in the automotive sector, you're dealing with these inescapable fixed costs.
Right.
You have to build a multi-billion-dollar factory. You have to tool the massive stamping machines, secure long-term lithium supply chains, and, staff the production lines well before a single customer actually takes delivery.
You're paying for the commercial kitchen whether you build 1 car or 10,000 cars.
Exactly. The only way to dilute those fixed costs is through massive, unrelenting scale.
You just have to pump out the lemonade.
Right. You need volume. But they haven't reached that scale, and the macroeconomic environment has shifted so dramatically against them.
Yeah, the report mentioned U.S. EV sales actually dipped in June 2026.
They did. So the domestic pie is shrinking, and legacy automakers are finally putting competent electric vehicles on the lots. Right. Add in Tesla and Rivian fighting this brutal price war for market share, and you're left trying to sell an ultra-expensive luxury sedan in a very crowded, very hesitant market.
Which honestly gives a lot of context to what CEO Silvio Napoli did on the earnings call.
Oh, yeah.
The report notes he just flat out refused to release updated 2026 guidance. He actually explicitly warned that Wall Street's consensus numbers for production and deliveries are too high.
It's unheard of.
Right. He stood at the podium and essentially told everyone to stop expecting them to do well.
That is a stunning admission from a sitting chief executive. Usually executives will bend over backwards to massage a bad quarter.
Oh, totally. They use all those euphemisms.
Exactly. They talk about macro headwinds or transitional phases,
Yeah.
supply chain realignments.
Yeah, corporate speak.
Right. So to explicitly tell the street that their delivery estimates are too high, that is a deliberate, forceful reset of expectations.
It's like pulling the fire alarm.
It's exactly the financial equivalent of pulling the fire alarm and telling everyone in the building, don't expect the fire department anytime soon.
So, okay, if the math is this fundamentally broken and the CEO is basically pulling the fire alarm, how does the company even attempt to survive this?
Well, they have a plan.
Right. I'm looking at their proposed solution here, this operational reset they announced. They mapped out a $1.4 billion cash reduction plan for 2026.
Right. And the breakdown of that $1.4 billion tells a very specific story about where they are applying the tourniquets.
Where are they making the cuts?
They're targeting $600 to $800 million in inventory savings. Then $500 million in capital expenditure cuts and $200 million in operating expense cuts.
And that includes the U.S. workforce reduction they did back in June, right?
Yes, the annualized savings from that are baked in.
Okay, and management claims this is going to provide a liquidity runway well into 2027.
That's the claim.
But let's just apply some basic logic here for a second. You just told me they burned roughly $1 billion in a single quarter. So a $1.4 billion savings plan spread over an entire year. Isn't that just buying them, at best, a few extra months of life support? I mean, it feels like putting a Band-Aid on a gaping wound.
The math absolutely supports your skepticism there, and it's a primary reason this equity report is overwhelmingly bearish.
Okay, let's get into the mechanics of these cuts then.
Sure. Saving $600 to $800 million on inventory means they're holding fewer parts in their warehouses.
Right.
They're moving to a much leaner, just-in-time manufacturing model.
But wait, in an era where global supply chains are incredibly fragile, I mean, we've all seen this, holding less inventory is a massive risk, right?
Oh, it's a huge risk.
If one shipping container of microchips gets delayed at a port, their entire production line could just grind to a halt.
And that is the hidden danger of inventory reduction. It saves cash today, sure, but it removes your shock absorbers.
Right.
Then you look at the $500 million in capital expenditure cuts. CapEx is the money you spend on the future, right?
By expanding the factory floor, that kind of stuff.
Exactly. Buying new robotics, tooling up for the next generation of vehicles. If you slash $500 million from CapEx, you are intentionally delaying your ability to scale.
It's a catch-22. They desperately need scale to dilute the cost of that commercial kitchen, but they are cutting the very investments required to achieve that scale just to, keep the lights on today.
And that brings us right back to the negative 92% gross margin.
Yeah.
Neither inventory cuts nor CapEx delays change the per-unit economics of the cars they're building right now.
Because it still costs double to make.
Exactly. If they don't fix the fundamental cost to produce the vehicle, then the moment they try to ramp up production again, the cash burn will just accelerate. If you lose money on every car, making more cars just bankrupts you faster.
Okay, so if the gross margins are a disaster, the cash burn is terminal, and the survival plan is basically starving their own future growth, why hasn't Wall Street completely abandoned ship?
That's a fair question.
Because the stock is sitting at $7.78. That's actually up from its low of $2.37 in July. There has to be something propping this up because the product roadmap looks incredibly bleak.
It is bleak. I mean, the research report highlights a critical delay. Their highly anticipated midsize vehicle, which is the cheaper mass-market car they desperately need to get that volume,
Right.
has been officially pushed back to the second half of 2027.
Wow.
So for the next 18 months, they are entirely reliant on their ultra-expensive Air sedan and the Gravity SUV.
But despite all of that bad news, the report shows insiders have actually been buying the stock.
They have.
Over the last 90 days, there were 11 buy transactions by company insiders totaling over 282,000 shares. How do we even parse that? Is that a signal that the executives know something we don't, or is it just like a drop in the bucket?
Well, it acts as a psychological floor for the market.
Okay.
Now, 282,000 shares against a multi-billion-dollar market cap, that is a relatively small financial commitment.
Right. It's not a lot of money in the grand scheme.
But the optics carry weight. When executives who see the daily cash burn still use their own money to buy equity, it tells retail investors that the leadership team believes value can still be salvaged.
It prevents a total collapse of confidence.
Exactly.
Well, I think I know what they are trying to salvage, and it brings us to this sci-fi pivot that absolutely blew my mind when I read this report.
Yes, the robotaxis.
Yes. They announced a robotaxi program. They're partnering with Uber and Nuro, and they are promising prototype robotaxis by the end of 2026 with actual production by early 2027.
The autonomous ride-hailing pivot. It is a very familiar maneuver in the tech and auto sectors.
Look, I just have to push back on the sheer absurdity of this timeline.
Please do.
They cannot figure out how to build a regular human-driven car without losing massive amounts of money. And their solution to this existential crisis is to, what? Casually invent a fully autonomous robotaxi in the next 6 months.
It sounds wild when you say it out loud.
It is wild. Let's look at a company like Waymo. They have spent over a decade and tens of billions of dollars physically mapping cities street by street, iterating hardware, and running millions of miles of simulations just to get a localized fleet working.
Right.
And this company is going to catch up to that by December.
Yeah, the engineering gap you just described is insurmountable in that time frame. You have to view this announcement not as a serious engineering roadmap, but as a deliberate financial strategy.
Okay.
In equity analysis, this is known as a speculative catalyst.
So you mean it's essentially a shiny object meant to distract investors from the cash burn?
That is the exact mechanism at play here. They don't have the runway to wait for their midsize vehicle in late 2027. They need a narrative bridge to get them through the next 18 months.
And the robotaxi is that bridge.
Right. It serves that purpose.
Yeah.
It gives retail investors a futuristic concept to dream about. It shifts the entire conversation away from, hey, we're losing $1 billion a quarter on sedans, to, we are partnering with Uber to revolutionize global transportation. It keeps the stock price elevated just enough that if they need to issue more shares to raise capital, they can actually do so without completely destroying shareholder value.
So they're essentially selling a story rather than a fundamentally profitable product.
Precisely.
And, speaking of selling a story, that connects perfectly to the meta layer of today's analysis. Because how do everyday investors even digest this wild mix of terrible margins, insider buying, and sci-fi robotaxi promises?
They usually turn to financial media.
Right. Which brings us to our second topic today, this leaked production guide for the financial YouTube show Market Pulse Daily.
This document is a remarkable artifact. I mean, it really pulls back the curtain on how modern financial media operates.
It really does.
When you watch these, 10 to 12-minute stock analysis videos, they feel off the cuff. The hosts seem like they're just chatting about the day's market news. But the leaked guide proves that every single second is meticulously engineered.
It is a rigid psychological formula. The guide literally mandates the exact language the hosts must use.
Yes, the 10 to 12-minute longer format they mentioned.
Exactly. It dictates that the video must start immediately with what they call a catalyst hook. Like, there are no friendly greetings, no slow build-up. The guide says you must hit the viewer instantly with the latest price action and the main catalyst.
Right. They want to hook your anxiety right out of the gate.
It's wild.
The underlying psychology is incredibly cynical, but it's highly effective. In volatile markets, anxiety drives engagement.
For sure.
If you are a retail investor holding this stock and you see a headline about a massive earnings miss or a sudden robotaxi pivot, you are experiencing acute financial stress.
Yeah, you're freaking out.
Right. The media platform understands this, so they mandate an opening hook that validates your stress by immediately addressing the volatility, implicitly promising that if you just keep watching, they'll give you the answer.
But giving you the answer isn't actually their primary goal. Because right after that catalyst hook, the guide forces the hosts to seamlessly integrate an affiliate pitch.
Ah, yes, the CT.
Right, the call to action. In this specific playbook, they're instructed to push a product called StockOracle. And the manipulative language they are mandated to use is just fascinating.
Only specific.
They have to pitch StockOracle as this AI-aided stock research platform, throwing around these proprietary buzzwords like OracleIQ and OracleValue.
It's a classic appeal to authority. By wrapping their pitch in the veneer of artificial intelligence, they are selling the illusion of algorithmic certainty.
Right.
They know the viewer is overwhelmed by the chaos of a volatile stock, so they present this magical AI tool that can supposedly cut through the noise and predict the unpredictable.
But the contradiction in the guide is hilarious to me. While they're forced to sell the AI as this powerful predictive tool, the script also actively forces the hosts to bury the reality of what the AI actually does.
Oh, disclaimers.
Yes, the guide mandates a wall of legal disclaimers. The hosts have to explicitly state that the AI insights and valuation estimates can be incomplete or entirely wrong, and that the data might be delayed. They're selling you certainty while legally covering themselves when the AI inevitably hallucinates a terrible price target. And they have to be careful to mention that it's an affiliate link and they earn a commission, but get this. They aren't allowed to read the full URL aloud.
No, just point to the 14-day trial link below in the description.
Exactly. Which brings us to the behavioral rules section of the document. The hosts are strictly forbidden from giving buy, hold, or sell ratings.
Right, because that crosses a legal line.
They cannot guarantee profits. They cannot directly tell listeners what to do with their money. They are walking this razor-thin legal tightrope.
And this is where the structure of the show becomes so revealing.
Yeah.
The guide mandates that the hosts spend the bulk of the video doing this pros versus cons debate.
Yeah.
They have to cover the fundamental catalysts, the market sentiment, the upside case, and the downside risks.
And when you watch it, it feels like highly objective, balanced financial analysis.
Exactly. But the ultimate goal isn't to give you a definitive answer on whether to buy or sell. The entire debate is just a retention mechanism. It's designed to keep you engaged just long enough to get you to click that 14-day trial link for StockOracle in the description box.
So look at it from a broader perspective. The product of that YouTube show isn't the financial analysis. The analysis is just the packaging. The actual product is the viewer's attention, and that attention is being sold to the affiliate software company.
It's a perfectly designed funnel.
Right, and let's draw the ultimate connection here because this is the real aha moment for me. Look at what both of these entities are doing.
Okay.
You have the car company burning $1 billion a quarter because they cannot manufacture their core product profitably. So what do? They pivot to selling the robo-taxi dream to keep their stock afloat and their investors distracted.
And on the other side, you have the YouTube channel.
Exactly.
They cannot legally give you actual financial advice, and they know the market is entirely unpredictable. So what do? They pivot to selling the AI predictor dream to keep their affiliate revenue slowing.
Neither of them is selling a fundamentally real, profitable core product right now.
Right.
They are both just selling stories. They are managing narratives to survive.
That is a profound parallel. I mean, in an era of extreme information overload, the companies themselves and the media that covers them are heavily incentivized to monetize your confusion.
So as a listener sitting at home trying to make sense of a company balancing on this terrifying knife edge of delayed products and cash burn, how do you actually cut through the noise?
It's tough.
If the YouTube videos are just affiliate traps and the CEO's robo-taxi promises are just speculative, shiny objects, what should you actually be looking at?
You have to strip away the narrative and focus entirely on the unglamorous mechanics.
Okay, like what?
Well, if you're watching this stock, you can completely ignore the robo-taxi prototype announcements. You could ignore the AI-generated valuation estimates from affiliate software. The only metric that fundamentally matters in their upcoming Q3 2026 earnings is whether that negative 92.46% gross margin improves.
Like, does the massive commercial kitchen finally start producing enough lemonade to justify the rent?
Exactly. Even if that margin only improves to, say, negative 70%, that is a tangible mathematical signal that their operational reset is actually working at the per-unit level.
Right, it means the bleeding is slowing down.
Yes. But if that number stays flat or drops further into the negative, then all the $1.4 billion savings plans and all the Uber partnerships in the world won't save them. The math always wins in the end.
It's just gloss on a broken machine.
Pretty much.
Which leaves us with the final thought to ponder today. We are looking at a company that builds arguably some of the most beautifully engineered, critically acclaimed electric vehicles on the road.
They are gorgeous cars.
And yet, the financial reality of building that physical hardware is so punishing that they have to suddenly pivot to software and autonomy just to keep the lights on? Are we witnessing the end of the traditional automotive startup era?
It's a great question.
Is it simply too expensive and too structurally complex to start a car company from scratch without the backing of a massive legacy conglomerate?
It really challenges the entire Silicon Valley ethos that you can disrupt heavy industry with just enough venture capital and a good idea Hardware is unforgiving.
It really is. And as you ponder whether the era of the hardware startup is dead, think about the media you consume to track these very companies.
Always be critical.
The next time you hear a financial news host breathlessly reporting on a stock's massive daily move, promising that their new proprietary tool can help you decode the chaos of the market, take a step back.
Yeah.
Ask yourself, are you actually being informed by an expert, or are you just the target audience for a meticulously scripted subscription trial? We start today talking about the illusion of flawless engineering. It turns out, whether you're looking at a $100,000 luxury EV or a 10-minute stock update video, you always have to look under the hood to see who is actually paying for the ride.